investors, this is the Young Investor Guy. Welcome to the channel for investors. So, the energy sector and the prices of oil have plummeted. There are many investors and traders looking to capitalize on this opportunity. What we'll have to realize is many of these companies are actually going to go bankrupt. So it doesn't really matter how cheap some of these companies are, or they may look undervalued at the moment. If you actually put the money in these companies, they will actually end up going zero. Given we're in an unprecedented time like this, no one really knows how low the price of oil can go. So what we can do instead is choose oil companies that have a strong balance sheet, strong cash reserve, so we know they will be the last man standing. Or in this case, the last company standing. In this video, we're going to look at the top 5 oil stocks that have strong balance sheet, good cash reserve, good cash flow, good amount of assets, as well as capital to actually utilize its efficiency. And also we're going to look at its past dividend history to ensure they will be able to weather the storm and this oil crash. At any time right now or during this video, please be sure to give this video a like. And let's just get all the investors to unite. First of all, it is important to note the differences among all the different oil companies. When we talk about oil companies, we can generally break them down into 3 categories: oil drillers, pipeliners, and refiners. Or you can also call them upstream, midstream, and downstream. Number 1, oil drillers or the upstream companies. These are the companies that go underground, drill a hole, and pump fuel out of the ground. Number 2, pipeliners or the midstream companies. These are the companies that mainly do the transportation. So they would take the oil from the drillers and actually transport them. Number 3, the refiners or the downstream players. These guys would actually take the oil from the pipeliners and actually refine them into a usable product. An example of that would be gasoline used for your car. They would turn the crude oil into actually usable gasoline. Number 4, the integrated oil companies. These are the guys that do everything from upstream, midstream to downstream. It is essential to understand which category of the company you are buying, as they all make money differently. For instance, the refiners actually make money from acquiring the oil and then turning them into usable oil. So in this situation, the cost of oil is actually quite low, and these guys actually will be able to benefit from it. On the other hand, if the oil stock you're investing in is a driller, you would be in a big risk because these guys are actually allocating a lot of debt and money towards the drilling. And when the price of oil is not going well, these guys would actually suffer and not be sustainable in the long run and have the highest chance of going bankrupt. Another example, let's talk about the price of milk. Let's say the price of milk drops like crazy. The dairy farmers are the ones going to be in trouble. What about yogurt companies? These guys will actually be okay because they refine the milk and turn them into yogurt. So for the yogurt companies, they actually benefit from this situation. So you can actually think of the refiners more as like the yogurt companies. So they don't actually lose out completely on a situation like this. While the refiners only have to worry about customer demand at the moment, the drillers would actually have to worry about not only demand, but also costs and storage issues. In buying oil stocks in this environment, here are some metrics I look for. Number 1, debt to equity ratio. Number 2, free cash flow. Number 3, current ratio. Number 4, the ROCE, or also the company's return on capital employed. Number 5, the dividend history. The debt and equity ratio measures how much leverage the company is using. For each dollar of equity, how much debt does the company have? In this environment where companies are trying to preserve cash, we need to find stocks that have a low debt to equity ratio. Generally, a number between 1 to 1.5 is considered good, but in this situation, we would actually have to compare it with the same industry and actually see which one has the lowest number. The lower being the better. Number 2, free cash flow. Free cash flow can tell us how efficient the company is at generating cash. In a situation like this where cash is important, the more the cash the company has, the longer they can survive. Number 3, current ratio. Current ratio is a liquidity ratio that measures the company's ability to pay its short-term obligations within a year. The formula for current ratio is current assets divided by current liabilities. So you can see for every liability how much asset the company has. The higher the ratio, the better the company is positioned to weather the storm in case they have to liquidate their assets and actually pay the debt. We can also look at the ROCE, the company's return on capital employed. This will tell us how efficient the company is at generating profit based on the capital employed. The formula for ROCE is earnings before interest and taxes divided by capital employed. And capital employed is actually total asset minus current liabilities. This way we know for every dollar the company invested in capital, we can see how good they are at translating that capital into profit. This can give us an idea about how efficient the company has been managing its capital, and also gives an indication moving forward how good they will be with managing resources. Number 5, dividend history. It's also good to look at the dividend history to see how long they have been paying out the dividend as well as dividend growth. Although there's a high chance a lot of companies will be cutting their dividend, the ones with the dividend crown, they will want to ensure to keep that status and continue to pay out the dividend. And now, here are the rankings. We're going to be basing these rankings on the 4 metrics I mentioned above, and let's evaluate them and see where they rank. Coming in at number 5, British Petroleum, BP. Now BP has a debt equity ratio of 0.79 among the oil stocks on this list. What I like about BP is the amount of free cash flow it has on its balance sheet. The company has 10.3 billion of free cash flow, and that's ranked 3rd among the top oil companies on this list. BP also has a reasonable current ratio of 1.1, meaning it has enough assets to liquidate if they need to. Now BP also has a fairly good ROCE average at 7.3% compared to its oil peers. BP has also been paying out dividend for a long time, and its dividend growth of 7 years. BP has also been very consistent with its dividend, and the only time they cut the dividend was during the oil leak incident in 2010. Coming in at number 4, the good old reliable ExxonMobil. ExxonMobil currently has a debt equity ratio of 0.25, and you see that's one of the best out there. Exxon also has a free cash flow of 5.36 billion. Its current ratio is at 0.8. Meaning that Exxon actually has more current liabilities than assets at the moment. Also means in the short term, they may need to sell more of their longer term assets in order to meet these short term obligations, or they would have to cut costs. The company has a total asset of 363 billion versus total liabilities of 164 billion. So they will still be in good shape if they have to sell some of their assets. In terms of dividend, the company has been a consistent dividend player for many years. We see Exxon has had dividend growth of 37 years. However, we do see they have a high payout ratio, meaning they won't have enough to pay for the dividend. So they'll most likely have to cut spending or sell some of their asset to keep the dividend. Coming in at number 3, Royal Dutch Shell. The company has a debt equity ratio of 0.52 among the top oil stocks. Its free cash flow position is a stunning 19.2 billion. The company also has a current ratio of 1.2, ranked 2nd in this category on this list. So the company clearly has more assets than liabilities in the short term and can pay their obligations by selling their assets if they ever have to. Royal Dutch Shell also has an ROCE of 7.07% among its peers, making it one of the most efficient companies utilizing its capital, which may also give us an indication of how efficient the company can be during this oil downturn. Shell's dividend has been consistent, but we noticed that they haven't increased their dividend since 2014. At the current moment, Shell also has a high payout ratio, meaning the current dividend will most likely not be sustainable and they might have to find a way to keep the dividend or cut down their costs. Coming in at number 2, ConocoPhillips. This company has a debt equity ratio of 0.43, putting them at number 3 only behind Chevron and Exxon. The company's free cash flow has close to 4.5 billion. Although this is not as strong as all the other oil majors, 4.5 billion is still a very impressive number. ConocoPhillips also has the best current ratio at 2.1, meaning it has twice as many assets than liabilities. ConocoPhillips also has an 11.5% return on capital employed, making it one of the best in the category among its oil peers. ConocoPhillips has had its ups and downs in its dividend, and we see that the growth is only at 3 years. This is because the company did slash its dividend in 2016. In my opinion, dividend is not the most important thing right now. What is more important is sustainability and whether the company can stay in business. Ranking in at number 1, the company best to weather the storm, and you know what the name is. It is Chevron. Chevron is the best in the business, and in my opinion, if all oil companies are to go bankrupt, this company would be one of the last ones standing. Now, Chevron has a debt equity ratio of 0.19, so that's best in the business. And this is crucial just in a time like this, and it's great to know they're already keeping their ratio low. The company also has a $13.2 billion of free cash flow only behind Shell. Chevron also has a current ratio of 1.1, so they do have enough assets than liabilities in the short term. The company has a slightly lower return on capital employed than others, and the figure also reflects a $10 billion write-off in the past quarter, but it's not a huge issue in my opinion. The dividend also doesn't look stable at the moment, and the company will also most likely have to cut its expenses or sell its assets to continue the dividend payment. However, we do see some encouraging news as we see that the company has actually never missed a dividend payment since 1934 during the Great Depression. The CEO has also spoken about doing their best to maintain the dividend. Investors, what are your top oil stocks? Do you have any of them that should make this list? Also, please be sure to like this video if you haven't done so. I would really appreciate it. And again, I'm not a financial advisor. These are just my opinion towards the companies, towards the stocks. Please invest carefully at your own discretion. Thank you very much again, and I'll see you next time.